Welcome. Today we tackle the IPO first day pop that retail investors often dream about. Does it really work out that way? An offer at $20 that trades near 40 on day one makes great headlines, but it shows up in your own portfolio far less often than on cable news. Today we look at both the hope and the reality of IPOs side by side. How do you get shares? How often do big pops happen, and why do losses show up? We'll walk through it step by step on this S&P 500 backdrop you see here. IPO means initial public offering. A private company lists shares on an exchange like the NYSE or NASDAQ, so anyone can buy and sell them. Offer shares are the stock you can buy at a fixed offer price just before trading begins. Think of a coffee priced at $3. The sticker is set, even if the market later wants $4.50. Picture a new tech name listing and filing that it will sell shares at $20 each. If you request an allocation through your broker and you're lucky enough to get filled, you can trade that stock from the first day of listing.
That's the IPO allocation.
Here's the key point. The company and underwriters set the offer price, but the first day's real price is set by the market, the demand of thousands of buyers and sellers.
IPO usually runs in 3 stages.
First is book building. Big funds and institutions tell underwriters what price and size they'd take, like getting several appraisals before selling a house. Those bids plus how much capital the company wants to raise get blended into the final offer price. It's a judgment call by bankers, not a guarantee of fair value. Second is retail access. On your broker's app, you may see a chance to request IPO shares, often only a few days before listing, and usually only if your broker participates. Fills are scarce. Some brokers run lottery-style allocations. Others favor active clients. Asking for $1,000 of stock does not mean you get $1,000 worth. Third is listing day. Shares begin trading on the exchange at whatever price the open auction finds, not at a fixed sticker anymore. From that moment, the market sets the price, and Fed-driven risk appetite can swing demand hard. Now, the reality check. If the offer is $20, how will the market value that company on day one? In many recent IPO cohorts, a majority of deals open above the offer. That sounds encouraging. But an average across deals is not the same as the one ticker you got filled. A meaningful minority open below the offer from the first print. Severe cases can trade near half the offer. $20 becoming about $10 on day one has happened.
Why?
The market can decide the offer was rich versus the company's business, competition, and growth story, especially when NASDAQ risk appetite cools after a Fed hike cycle. Huge day one doubles are rare. U.S. stocks have no Korean-style daily price limit, so a pop can be large, but that still requires buyers to overwhelm sellers. That imbalance does not show up in every deal. If you receive retail IPO shares, can you sell on day one? Usually yes. Retail allocations are typically free to trade. The trap is elsewhere. Lockups on insiders and early investors. Founders, employees, and venture funds often cannot sell for about 180 days. That lock supply is a ticking calendar for anyone still holding after the open. In those months, the stock can rip higher or slide hard. Names that jump 50% in the first 2 weeks and sit 30% below the offer by lockup expiry are a real pattern in U.S. aftermarkets.
Why?
When lockups expire, often around 3 to 6 months, a wave of insider selling can hit the tape at once. Traders call the soft patch after that the post-lockup fade. So IPO profit is mostly about when you exit. You might sell into day one strength while locked up shares wait, or you hold into lockup and accept that losses can widen while you wait. Across many recent U.S. IPO years, Opening above the offer has been more common than opening below, but the mix flips with liquidity, ASEC sentiment, and the Fed's rate path. Even among deals that open green, outcomes are all over the map. Only a thin slice are huge winners of 50% or more. Many are modest pops. A large chunk barely move. A majority above offer does not mean a majority of big paydays. Put differently, if 10 people get filled, maybe 1 or 2 see a large gain. The rest see a small bump or lose money. That is the lived distribution. Losing deals still show up often enough, including drops of 50% or more from the offer within weeks. Buying at $20 and holding a $10 stock a month later is not a hypothetical cartoon. The main takeaway: averages are averages. Whether your allocation behaves like the average depends on that company's business, the market cycle, and the industry outlook, not on IPO folklore. IPOs always go up, and a first-day double is locked in are false. That guarantee does not exist. Plenty of deals lose money for holders. Before you request shares, study the actual business, competition, and industry growth yourself. Judge whether the offer looks reasonable. Read the S-1 prospectus and investor materials. Do not skip the risk factors. Set a sell rule in advance. Deciding if I'm down 15% for my cost, I'm out before you click request reduces emotional trading later. Greed clouds judgment more often than people admit. The real opportunity in an IPO is early access to a new public company. Spotting a strong business early is a genuine edge. Opportunity still does not guarantee profit. This lesson is educational. It is not an investment recommendation. You own every investment decision and every loss. The instructor and platform are not responsible. Always verify filings yourself and decide carefully.